Let's talk to Nicole Elliott. She's a private investor and technical analyst. Very good morning to you, Nicole.
Hello, Nick.
Right, we've got three markets to go through today, all European indices. Let's kick off, without further ado, on the Swiss exchange, a monthly candlestick chart. What are your thoughts?
Well, this was one of the clearest examples that you had topped. And if you look on the right-hand side there, this single candle is a shooting star. Normally in technical analysis, you want a whole load of things to back up a kind of idea you have.
Okay.
But every now and again, something so powerful happens, you chuck out the rest and just focus on the one.
Okay.
And that was that one there on, in January, you saw the thing try to go higher and fail quite miserably. Now you had something similar, but not so extreme on other indices. Now, you see I've got no lines on there, no nothing. But I think you should have already, if you've got your thinking cap on, realised that we'd failed several times at this 9,500 level. So rather than just sort of sit and hope, before you even get there, you should consider what action you're going to take. And let's not forget, the best timing tool is technical analysis, in my mind, no doubt about it, right? So already you're thinking ahead in December saying, gosh, you know, we've got to the level where we peaked in 2015 and 2007, you know, hang on a minute. And as if that's not enough, my memory goes back a long way, and we'd actually peaked somewhere between 8,500 and 9,500, not only here in the last decade, but also in the year 2000 and in 1998.
So a massive
where we
cycle
are today... Where we are today is where we were 20 years ago.
Right.
I mean, hard work or what? Thank God for
absolutely.
dividends, eh?
Yep.
Thank God for dividends. Otherwise, this thing is awful. And what you've got working against you, as if that weren't enough, working against you, you've got the Swiss National Bank with negative interest rates, selling the blazes out of their own currency, buying anything and everything else. So no wonder this index is really struggling. It's absolute cliff face, isn't it, that it's trying? And I'm afraid it looks as if it's failed quite badly. Now, we're only mid-month now, so it might sort of recover a bit. But what you've got is this very big, so far, potentially bearish candle that's going to be bigger than what, 6 or 8 months before it. Do you see what I mean? So it's, in other words, it's engulfing the previous, I can't see quite here, but it's a good 8 months, a good 8 months there that you've unwound in a fortnight. I mean, this is scary stuff. This tells me that this market is, again, unhappy at these sort of levels.
Understood.
What am I looking for next? A weekly and a monthly close below 8.5 grand. And then we get our skates on again.
Okay, so potential top on the Swissy. Let's move on to the Dax weekly chart, the Ichimoku chart, which you're an expert in, with entering cloud territory, which is key support, right?
That's right, that's right. So we're off quite a bit on the DAX, but the difference is we're off from a new record high in January. Again, you've got a sort of quasi little shooting star there at the record high. So already before we started selling off hard, it was warning you, it was flashing, hang on a minute, I'm not really happy. You've got a potential double top with the high in the last quarter of last year, So it's not perfect, but it's good enough. 13,400 area, okay? So you've got the letter M there, and now you've gapped below the 2 moving averages, where the 9-week moving average has come tumbling down, courtesy of the move at the last the end of January, beginning of February, and lots of follow through too. Now, as I say, we've dropped by 12%, which conventional textbook thing says we're still in correction territory, not bear market. And certainly the chart would back that up. As you say, we've got support from this cloud, we've got support from this trend line. We haven't even got to a Fibonacci 38% retracement yet. But I think that would be the sort of do or die sort of level there at 11,700, okay? Because by that, if we were to break that, and I don't care when, it doesn't actually matter when, but if we were sort of to start holding below that, then it would mean that I'd be below the cloud, below the trend line and below first retracement.
And thinking bearish things on the charts. Okay,
Yeah.
let's wrap up the segment with a daily chart, the AEX, which is the Amsterdam index. There's some nasty looking gaps on that chart.
That's interesting you point that out, because some indices will never, ever, ever gap, because the index is recalculated as at the previous close, and then as each share trades, right? So that's the case with the Dow Industrials, that's the case with the FTSE 100. But other indices don't. They just get going on the day, and this is where it is now. So that's why you see those. And what's the key thing about those gaps is that well, there's a little one and then two jolly big ones glaring, aren't they? Absolutely unlike anything on the way up.
And it gapped to the upside, so you've almost got an island reversal there as well.
Exactly. And also you're between the 50-day moving average, which is the green one, and the 200-day moving average, which is the blue one. So you've got all sorts of things happening, as you say, right at the top there, and this is not an all-time high. In fact, we're here at 570. In fact, the peak for this index was actually in the year 2000, when it was at 700.
Okay. So
at 600, we peaked in 1998. So on this thing, we're back down to the sort of levels that we had in 1996, 97. So it's underperformed even the Swiss market index. So all this business about the Eurozone being such a great economy, well, it's certainly not reflected in the share prices in many indices, many of them. Now, what we've got here, the other thing is that the sort of media hype at the moment is that, oh, it's fantastic, we're all bouncing back, it was only a little correction, we're probably done and dusted. Well, I beg to differ here, because the bounce that we've seen from last week's low, by my reckoning, is utterly pathetic. It's not even a rally yet. It's a joke.
Right.
It's a little
Well, that's a horrible looking chart, right? And there's no... there's no dead cat bounce there, is there, really?
And the other thing to remember also is that bull markets and bear markets, by their nature, are totally asymmetric. I mean, here, in 2.5 weeks, we've managed to undo all the work that we've done since September.
Yep.
I mean, this is what's scary. That's why you've got to consider, whether you want to be fully invested, partially invested, or hedge it.
Yep.
All along, these kind of decisions must be made continuously and refreshed with past
My last point
action
on this
and more.
is that I was taught, in terms of uptrends, invariably you've got some sort of consistency. And if you start pulling back, you get inconsistency. And there's inconsistency in that trend now, isn't there?
Very much
and the
so.
textbooks would say you've got gaps, which is dangerous to the downside. You haven't really got a reversal pattern, but a bullish reversal on the bounce, and you've got that horrible island top at the moment. I know which way I'd be, Nicole.
Well, also, can I just add that this whole sell-off could be seen as an irregular inverted pennant, like the thing in the golf course, but turned upside down, right? So you've got the long pole, and this little flaggy bit at the bottom.
Yeah, having a rest before we have another leg down.
Correct.
And on that note, we'll see you in 2 weeks' time. That's Nicole Elliott, private investor and absolute keen technical analyst. Thank you.
Thank you.